Yes, yes. So once again, good morning to all of you. Good to see you all again. For those I can see. How was yesterday? And how's been the training so far for you? Yeah, good. You've been learning some practical as well as exam-oriented stuff. Can someone do a quick recap of what we did yesterday? What we did or you all did? I mean, you might have had full day session. I took about 3 hours out of that. What did you learn yesterday? Anyone can unmute and talk. No, no one wants to talk. SEBI regulations. Yes, Mr. Sudhir. So yeah, give me just an example. Don't give the topics. Let's talk about what did you learn yesterday. One point that you remember from yesterday. Either of the sessions. The my session, somebody else's session. FEMA. No, again, that's the topic, right? What did you learn within FEMA? 20th July. What is 20th July? Filing date. Okay. Yeah. All right. Anybody else? Once again, Shushantu sir, let's speak up, right? Let's talk about one point that you remember from yesterday. Free cash flow to the firm versus free cash flow to equity. Okay, what's the difference between free cash flow to the firm and free cash flow to equity? Let's talk. That's very important. Very, very important. Don't unmute and talk, sir.
Like starting from yesterday,
Go on, sir. Yes.
starting from yesterday, we learned about
Yes, Rohani, go on.
free cash flow from firm, free cash flow from equity. Basically, the equity considers only that portion, uh, like Sir explained with the help of a diagram as well. Like there was a inner circle which consists of only equity. So when we are considering the equity, we have to consider cash flows of all the other factors, and we'll take the discounting factors of only equity. Discounting for discounting, the rate should be considered only for equity, while the cash flow should be considered of preference, debt, any other factor. While if we are calculating free cash flow for the firm, then we'll consider the interest rate, which consists of all the factors like equity, preference shares, and short-term, long-term debt. But free cash flow, the cash flow will include various other factors, leaving the equity, preference shares, and long-term debt. So this was a very good understanding he gave us.
All right. So we will reinforce that understanding. Thank you so much, Suhani. We will reinforce that understanding today also. Okay. So we will start off our today's session. We will talk about valuation approaches and methodologies. Okay. I'm not sure if you're familiar, but there are valuation standards which are there. And when you become a registered valuer, or any valuation for that matters these days, are supposed to be as per the valuation standards. And the valuation standards talk about valuation approaches and methodologies. So we will talk about that today. Okay. It is going to be a reinforcement of what you might have done in the past, but at the same time, there are some very important things that we will learn today as well. Okay. So as I said, we will talk about valuation approaches and methods. So okay. So we will talk about international valuation standards as well as ICAI valuation standards. When I say ICAI here, it is the CA Institute, the Institute of Chartered Accountants of India. Okay. So what are we going to discuss today? We will discuss about the market approach, the income approach, and the cost approach. Now, you've already studied the three approaches, right? That's what I'm told. Even yesterday, you mentioned that you have covered the three approaches. Yes. But let us look at the three approaches from a valuation standards perspective, when to apply them, when not to apply. Right. So before I move on, can someone tell me, right, when do you apply the DCF approach? Should you apply it every time, or are there considerations when you should apply DCF approach, the discounted cash flow approach?
Income approach and
When you make a projection for next 5 years, suppose to say for a company,
Yes.
okay, so cash flow what will be? So that's why you need to do DCF approach.
Okay, no, so that's
Or
not
rather say
my
what
question. Yeah, go on, sir.
so so
Shubhitra
just
sir,
consider
go
this
on.
one, that what will be the work. So what will be the working capital for next 5 years? Suppose I'm projecting for a firm. Okay, so what will be the projecting capital as well as the equity, or as well as just see the performance on the basis of which I can project. Okay, suppose I need to send one report to bank or anybody else. Okay, for the purpose of getting
Okay.
loan. So for the purpose of getting loan, I need to make a valuation. So what will be the cash flow for the next 5 years from collection as well as the payable point of view? So that's why I need to make a cash flow, and for that I need to discounting factor have to apply.
Correct.
Okay, what will
Okay.
be at present my valuation?
Another reason is that when the cash flows can be ascertainable with a certain degree of accuracy, as well as that life of the project also can be estimated. In those cases, that DCF is much more suitable.
All right. Yes. So now let's say I'll give you an example. Let's say you are hired by a company which does valuation, which does accounting under Ind AS. Okay. Everyone's familiar with the name Ind AS, the new accounting regulations that apply to all the listed companies and large organizations. The company has got certain investments. Okay. So under Ind AS, the company has to report the financial assets at fair value. And we will talk about Ind AS tomorrow. Right. Now, let's say you are hired by this company to value all the investments. And the investment includes, let's say, shares of all the listed companies. So it has got Reliance Industries, it has got TCS, it has got Wipro, it has got Tata Motors, and it also has a Omnifin Solutions Private Limited. Right. So this company holds some shares of listed companies as well as unlisted companies. Now you are required to ascertain the fair value of the investments. Okay, that's your job. Now, what will you do? How would you value these companies? So on one hand, you have Reliance Industries, TCS, Wipro, Tata Motors. On the other hand, you have Omnifin Solutions Private Limited. How would you value these companies? How would you arrive at the fair value of these companies?
First four cases, market value approach. Okay, because they are
Okay.
having, these are quoted shares. Okay, so prices are available in the market as far as Ind AS 113 is concerned, or IFRS 13 is concerned. Okay, for unlisted company, unquoted share I can use, or rather than say this one, if it is not available, then I can go for DCF.
Okay. Now there is another company, let's say, which is Byju's.
So if it is a listed company, suppose to say, okay, it's listed in NSE or
Byju's is not listed.
so unlisted
Byju's is not
company,
listed.
I can check this one, that if it is available, the same line of business, what is the market price of the share? Okay, rather than say this one, if it is not available, then cost price.
Okay. All right. Great. Right. And I also got a message in the chat box, which is recent valuation, recent transaction valuation. Correct. So you're right. Right. We are in the right direction. So basically, when you are not in the valuation fraternity and you talk to people in the valuation fraternity, almost everyone always says value the company based on DCF. Okay. Now, including Dr. Ashwath Damodaran. I'm sure everyone has heard of Professor Ashwath Damodaran. Have you? Yes, no?
No.
Have you heard of Ashwath Damodaran? No, you haven't. Okay, okay. So Ashwath Damodaran is the Amitabh Bachchan of valuation. Okay, or he's the Sachin Tendulkar of valuation. He's very popular. He's a professor of Stern University in the US, New York University, Stern Business School, and he's been writing books on valuation, and he's an authority in valuation for that matter. Okay, and for a very long time. So everyone you meet would typically say that valuation should be done based on discounted cash flow approach because it is a very good way of valuation. It is the best way of doing the valuation. Now, when you become a valuer, that is when you realize that it is probably the worst way of valuation. The reason why it is the worst way of valuation is because whenever you do valuation, you have to project. There is a subjectivity which is involved into valuation, and that subjectivity means you how many factors are questionable, or how many factors are debatable, or how many factors can have judgment. Okay, and in case of DCF, everything that goes into valuation is questionable or subject to judgment, and that is why two people doing the valuation under DCF approach independently can practically never come at the same value, just never. Okay, so we'll talk about what do valuation standards talk about, what method should be used, what are the methods of valuation, when should we use them, and what are the considerations around it. Okay, so that's why this session is very important. So we will talk about the three approaches, right? Now let's say we discussed yesterday, and I'm sure you're anyways familiar, that we become valuers under companies registered valuers and valuation rules 2017. Okay, so section 247 of the Companies Act says that there should be a registered valuer, and then there are rules of registered valuers, which is registered valuer and valuation rules 2017. As per rule 16 of the valuation standards, the valuation should be done as per notified valuation standards. So when you look at the valuation standards, when you look at the rules, there is a rule 16 which says that valuation should be done as per notified valuation standards. Now the word notified is important because the government has not notified any valuation standards yet. Correct? Since the valuation standards have not been notified, the rule also says that until the valuation standards are notified, valuation should be done as per an international accepted valuation methodology or valuation standards adopted by any valuation professional organization, or valuation standards specified by RBI, SEBI, or any other statutory regulatory body. Now, what does this mean? So, first of all, the rule says that whenever there is a valuation standard that has been notified by the government, you will have to do the valuation as per the valuation standards. But valuation standards have not been notified. So, what do you do till that time? Then you have three options. One, any internationally accepted valuation methodology. Now remember, it says valuation methodology. It does not say internationally accepted valuation standards. Now when you say methodology, as long as there is a valuation method which is used in India and Nepal, it qualifies as internationally accepted valuation methodology. Correct? But let's not skirt the law. Let us understand what is it trying to say. So in different parts of the world, different countries have different valuation standards. One of the most common valuation standards has been given by IVSC, International Valuation Standards Council. Okay, International Valuation Standards Council, and they came up with international valuation standards. Okay, so if you follow the international valuation standards, you are good. Second, valuation standards adopted by any valuation professional organization. Now, what is a valuation professional organization? Valuation professional organization does not exist today. That means, if you look, I'm sure you might be familiar that there is a new draft valuers bill which has been come out in 2020. And in the draft valuers bill, they use the term valuation professional organization. But now to understand what does it refer to, all the RVOs today, right? Registered valuer organizations. So there is Institute of Chartered Accountants of India, RVO. There is Institute of Company Secretaries of India, RVO. There is Institute of Cost Accountants of India, RVO, for which all of you are members. And there are 14, 15 such RVOs are there. So all of them will automatically be converted into a valuation professional organization. Okay. So just for, again, coming to the point, if the RVO, if any of the RVOs have adopted any valuation standards, you take up those valuation standards. You do the valuation as per those valuation standards. In India, only ICAI, Institute of Chartered Accountants of India, have come up with valuation standards 2018. Are we all okay so far? Some of your images are frozen, so I'm not sure if my voice is audible to you or not. Yeah, this is clear? Okay, great. So ICAI valuation standards. So now, as of today, we have IVS 2020 and we have ICAI Valuation Standards 2018. Okay, and they are quite different in terms of their numbers and approaches. Okay, quite different. So International Valuation Standard was first came out in 2017, and they have now updated it as of January 2020. So International Valuation Standards are applicable from January 2020. ICAI has not updated their valuation standards, so it remains at 2018. And if you were a member of ICAI RVO, then you would have to follow the ICAI valuation standards. Are we okay with this part? Are we okay with this part? Yes. So, however, since all of you are members of ICMAI RVO, ICMAI RVO has not adopted any valuation standards so far. So, we are free to use either International Valuation Standard or ICAI valuation standards. Okay? Third, however, in case you are doing any valuation under any specific statute, then you have to follow the valuation standards or the valuation methodologies which is given under that statute. For example, one of the common areas of valuation for financial assets and securities and financial assets is valuation under Rule 11 UA of income tax. Okay, so whenever a company is transferring the share,
Sorry to interrupt you. That valuation standard introduced by any of the RBOs, is it not required to be accepted and notified by the government of India? See, ICAI has, tell me. ICAI has now recently, ICAI has just made this standard, but is it automatically to be adopted for any valuation, or is it required to be recognized and notified by the government of India, central government of India? Can we apply this valuation standard right now?
It is the other way, sir. See, if you look at the slide once again, so first of all, it says that valuation standards should be notified by the ministry.
Correct.
Okay. If it is not notified or until it is not notified, you follow these, right? So the sequence is just the reverse. See, let's understand. So once you become a registered valuer, you are a registered valuer, right? Then it does not matter whether you are a registered valuer under ICAI or ICSI or ICMAI or ISMA or anything else, right? Valuation profession is very different from CS, CMA, etc. Valuation professional is between CACS, CMA and MBA. Please understand. So, for example, if you're a CA, you have to be a member of CA Institute only. If you're a CMA, you have to be a member of CMA Institute only, right? But when you're an MBA, you could be an MBA from any institute, isn't it? So, similarly, when you're a registered valuer, you can be a registered valuer under any institute. Does not matter. So, therefore, but the RVO, the Registered Valuer Organization, has a lot of power. So the RVO is supposed to regulate the registered valuers. Okay. So see, the government is trying to bring all the registered valuers at par. But as of now, they are not at par.
This INDAS is Indian Accounting Standards.
Yes, ma'am. What?
This INDAS is Indian Accounting Standards.
No, we are not talking.
Okay.
No. So we are talking about valuation standards. We're not talking about accounting. Niche, haan. This one is NDS. This one is accounting standards. We'll come to this later. Don't worry about this at the moment. Okay. Don't worry about this at the moment. We are only talking about A and B as of now. Okay. Let's understand. So what I'm trying to say here is that if you were a member of ICAI RVO, then ICAI will direct you to use only ICAI valuation standards. And that it has the power from the government that you can direct your members to follow any specific valuation standards. This is point B. So point B says that if your RVO says that you should follow these valuation standards only, you have to follow them. Okay. Incidentally, ICAI valuation standards do not apply to land and building and plant and machinery. They only apply to securities and financial assets.
Okay? Now my concern is the different RBOs come up with different kind of approaches, and then there may not be that
Correct.
much of a, so that synchronization, the
Yes.
problem may come up. Now, once upon a time, you may find that RBO ICMI is
Correct.
giving one kind of valuation standard for the same asset, and whereas that other institutes are coming up with different approaches, and these two valuers from the two RBOs are appointed for the same class of asset, the valuation, which and everybody can
Correct.
justify their ground. So no, my approach is as per this standard, so it comes out, it gives this figure. Whereas this institute
You
as
are
per the
absolutely right, sir. You are absolutely right. And as things stand today, this is what the problem is. And we will discuss this problem in today's session only. Okay? This is a problem. Now, see, you have to understand that the valuation profession is evolving in India. Okay? So, for example, I told you yesterday that on 1st September, IBPI has come up with draft disclaimers. These are the disclaimers that you should put. So, the notified valuation standards, till the time the valuation standards have been notified, this dilemma will continue. But eventually, the government will come up with specific valuation standards. Okay? Till the time we don't have it, this dilemma will continue. I totally agree with you. And we will discuss it today. Abhi discuss karenge. Okay? Then finally, we are saying that if you are doing the valuation, yes, sir.
Sorry to interrupt. Is this
Yes,
rule
Ruji.
16 or rule 18? I was just checking the rules, and I think from the material that we've been sent, it said rule 18. I just wanted to clarify that actually.
Um, I'll double check.
ठीक है.
I'll double check on that one. I think it was rule 16, but yeah, I'll double check on that one.
Fine. Okay. Fine.
Okay. Yes. And then coming to the third point, in case you are doing valuation as per a specific statute, then you have to follow the guidelines under that statute. For example, if you are doing the valuation under Ind AS for financial reporting purposes, and you are doing the valuation under, let's say, Ind AS 113, which is fair value measurement. So you have to, when you're reporting in your report that the valuation is done as per Ind AS 113, if there is a conflict between valuation standards and Ind AS 113, Ind AS 113 will prevail. Similarly, if you are doing valuation under income tax rule 11 UA, the prescription, the method under 11 UA should be followed to do the valuation under income tax. Same for FEMA, same for SEBI, and so on. Okay, so this now, because of 1 and 2, there is a dilemma, and let's talk about the dilemma as we go along today. Okay, so there are some similarities across the valuation approaches, and there are some dissimilarities as well. So what are these? Okay, again, the good part is both IVS as well as ICAI valuation standards talk about the same three approaches of valuation: market, income, and cost approach. Okay, ICAI valuation standard 103 prescribes these methods under valuations approaches. So remember, this is ICAI's valuation standard 103. Now, by the way, don't worry about the valuation standard numbers. Incidentally, the syllabus that you are following simply says valuation standards. It does not specify which valuation standard, whether they are talking about international valuation standard or ICAI valuation standard. They don't talk about that. They simply talk about valuation standards. Okay, so we'll still see what are the similarities and differences. So as per ICAI valuation standard, the three approaches are market approach, income approach, and cost approach. Under the market approach, you have three methods. Okay, now see, these are approaches and these are methods. So what are the three methods? First is market price method. Second is comparable companies multiple method. And third is comparable transaction multiple method. Market price, CCM, CTM. Okay, and we'll discuss each of them in details. Then next, under income approach, you have discounted cash flow approach, and everyone is familiar with that. Has anyone heard this term relief from royalty method? No? Okay. So relief from royalty method is typically used when you value intangibles. For example, if you're valuing a brand or fluid. Yes. So then you use relief from royalty method and multi-period excess earning method. Multi-period excess earning method can be used for intangibles also and can be used for companies also. Multi-period excess access earning method is also known as profit earning capacity method, right? And this is again used for goodwill as well as for companies. So there are different applications for MEEM. But typically, if there is a question on when do you use relief from royalty method or multi-period excess earning method, the answer would be for valuation of intangibles, example brands. Okay, we are not discussing these two methods in details today. We will only talk about these market approach and DCF approach. Okay. Finally, we have cost approach. Under cost approach, you have two methods as per ICA valuation standards: replacement cost and reproduction cost. Replacement cost is when you can replace the asset. Reproduction cost is when you can reproduce the asset. Both these methods are typically applicable for tangible assets. Generally, for tangible assets, we typically don't apply these methods for securities and financial assets. So we'll not go into details for this as well. Okay. I am not sure if any of you noticed that there is no NAV method mentioned here, right? There is no NAV method mentioned in this approach. NAV is net asset value method or book value method. So net asset value method or book value method are not mentioned in any of the valuation standards. So whenever you use the NAV approach, which is total assets minus total liabilities, right? You have to be careful to explain how are you justifying that the valuation is done as per valuation standards. We'll talk about that. Don't worry. Okay. Chale aage? Shall we move on? Yes. Okay. Now we have International Valuation Standard 105, IVS. The corresponding standard in IVS is 105. The previous one is 103. The first method that it says is comparable transactions method, or also known as guideline transaction method. Now, is this new or is it same as ICAI valuation standards?
It is same as ICI. No, ICI is also there. Comparable transaction method is there.
Yes. So this method is the same as CTM as per ICAI valuation standards. Okay. Comparable transactions multiple method. The second method is guideline publicly traded comparable method. Guideline publicly traded comparable method. Again, same as CCM. Okay, which is comparable companies multiple method. Now, can anyone tell me the difference between these two, comparable companies and comparable transactions? What's the difference?
One is on the similar companies basis. Another is the transaction of similar type.
So suppose a company which doesn't have any valuation or not quoted. So for that purpose, you need to check this one whether the similar line of companies available whose valuation is done earlier or not. If it is available, then we can take that valuation report for the, or which is applicable for the current company in which we are working.
Yes. So the first method, when we talk about comparable companies multiple method, this is always going to be for listed companies. Okay. This will always be for listed companies. This may be for listed, may be for unlisted. Number one. Number two, this can be used for various financial assets other than companies also. For example, you are valuing a brand. Can you value brand based on market approach? Yes, you can. Yes or no?
Yes.
Right? You can do brands based on market approach also. Now, how would you value brands based on market approach? You simply say, what are the different, what is the price to, what is the market value multiple of different brands in the same category, right? If there have been acquisitions of brands, for example, FMCG industry, there are so many acquisitions happening of brands. Yes or no? Between Hindustan Unilever and ITC and Procter and Gamble and so on. So you can use the comparable transactions multiple method for both companies as well as other assets. Like think of real estate. If you have to value the property, right, it's so easy to value a property using the market approach rather than the DCF approach. How would you value property using DCF approach? Correct. So comparable transactions multiple method has a very wide range of application. The third one is market approach. This is the same as market price method. Okay. So all the three approaches under market approach are same, both under International Valuation Standard as well as ICAI valuation standards. The income approach reference talks about discounted cash flow, which is the same. Income capitalization method, there is an indirect reference to it. It does not specifically mention. So as per the international valuation standard, income approach practically means only DCF approach. Okay. Practically means only DCF approach. Now, can you tell me how do you value the companies based on DCF approach? So what are the different methods? So one is FCFF, FCFE, right? Is there any other method under DCF approach also? Remember the first thing that you ever learned about valuation, maybe if you studied about securities analysis, no, such multiples is market multiples. That is under market approach, right? Remember we learned about dividend discount model, Gordon model of valuation of shares.
Dividend capitalization model.
All those are sorry.
Dividend capitalization model. We can use that one.
Dividend capitalization model, dividend discount model, Gordon model. All those are basic applications of the discounted cash flow approach only. Okay. Finally, when under the cost approach, you see these two are same, but it also talks about a summation approach, a summation method. Okay. Under the international valuation standard, it also talks about a summation method. What is the summation method? Any idea? Sum of the value of the assets, yes. And can you give me an example of how would you apply that? Where would you apply that? No? Yes? All right. Let me give you two examples. Yesterday we spoke about LIC. Correct? Now we discussed that LIC has got different land banks. Now all those land banks contribute to a huge value of this company, right? So on one hand, the company's business is the company generates income from insurance premiums. The second, the company generates income from investments, right? LIC has got huge investments in so many companies. And the third is it generates income from these non-operating properties, right? So if you have to value LIC as a whole, you cannot apply any of the market approach or income approach methods. So you will have to apply dividend model, DCF model to value the company, which is for its insurance business, which is the premium receivables minus the claim settlements, right? Yes or no? I'm just discussing it very basic at a very basic level. For a company like LIC, how would you arrive at its value? Very simplistically speaking, the main business is, yes, it is sum of parts method. Exactly, it is. Right? So the main business is the insurance business where it gets premium and it settles the claim. This is its main business. This has to be valued using the income approach, let's say. Second is its investment returns, because LIC has got investment in so many listed companies and so on. So it generates income from there, where it can be either the value of those investments plus the dividend income that it gets from those investments, or profit and loss on sale of those investments. And third is the land bank, once again a part of investment, but a very different kind of investment as compared to the stocks. So land valued in a single way, add the total value. Investment business valued in a single way, add the total value. And DCF approach for insurance business, add, get a total value. Here's the value of LIC. Okay. Similarly, think of a company like ITC. Now I have valued ITC, and they are my clients, right? And imagine how would you value a company like ITC? The same company has a cigarettes business, has hotels business, has paper business, has FMCG business, right? Has agri business, right? So many businesses under the same roof. You cannot apply any single method to value ITC. You just can't. Okay. So there you have to apply sum of the parts. So you value each of the businesses together, add them up, and say that this is the value of the company. You have to make some adjustments there. Okay, so we call it the sum of parts method, also known as the summation method. Are we okay with this? Yeah. Can we go on? Yes. Okay. Chaliye. So now, before we go into the approaches, it's very important to understand valuation basis. Now, valuation basis is given in the ICAI Valuation Standard 102. Remember, valuation rules specify the contents of your valuation report. It very clearly says that the valuation report should contain these headings. One of these headings is valuation basis and premises. Before you go into valuation approaches, we have to understand about valuation basis and premises. What are the valuation bases? There are three bases of valuation given under the valuation standards. First one is fair value. Everyone understands fair value. This definition of fair value is very important, and you should by heart this definition by now. Okay, fair value is the price. First of all, it kills the distinction between fair value and price. Value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the valuation date. Right? We're not going into the evaluation of the fair value definition. That is what is fair value. We also know what is liquidation value, right? Because since we are becoming registered valuers under IBBI, and the trigger for becoming for recognition of registered values is the insolvency engagements, where you have to calculate both liquidation value and fair value. So liquidation value is the amount that will be realized on the sale of an asset or a group of assets when an actual or hypothetical termination of the business is contemplated or assumed. It may be orderly or forced liquidation. Basically, what we are saying is one base is fair value, where it is an orderly transaction, right? I don't know you, you don't know me, you are interested about the asset, I am interested about the asset. I want to sell, but I'm not dying to sell. You want to buy, but you're not dying to buy. I am under no compulsion, you are under no compulsion. You have enough information, I have enough information. Now, what is the value at which we will get into this transaction? That value is fair value. Liquidation, I want to sell. I am under a pressure to sell, right? I may or may not have time, but I want to sell the asset. So therefore, there is a biasness when you talk about liquidation value. Okay. Now, these two have to be calculated when you are doing the valuation under insolvency engagements, IBBI engagements. But very interestingly, there is a third method or third base of valuation which talks about participant specific value. Can someone give me an example of what is participant specific value, or what do you understand by participant specific value? Good morning, everybody.
If a specific person is looking for doing the transaction, probably the person can be internal person or for a specific way, not in a general transaction. Like let us say an employee wants to buy an asset of the company or something like that, or it is between two related parties.
Okay. Yeah. So yes, so it could be between related parties, it could be between known parties, it could be works of art, it could be an auction, right? One of the best examples that I can think of right now is WhatsApp acquisition. You heard of WhatsApp? You know what, everyone uses WhatsApp, right? Do you know the value at which WhatsApp was acquired?
$19 billion.
$19 billion, right? And do you know the revenue of WhatsApp at the time of acquisition? The revenue of WhatsApp at the time of acquisition was 10 million M, and the acquisition was 19 billion. That is, it got acquired at 1900 times its revenue. Okay. Now, we're not going into the details of WhatsApp acquisition for the time being, but let's just understand. So Facebook acquired WhatsApp for $19 billion. Less than a year before its acquisition, Google had bid to acquire WhatsApp for $1 billion. Less than a year before its acquisition, Google had bid to acquire WhatsApp for $1 billion, whereas Facebook acquired WhatsApp for $19 billion. Now, does it mean Google doesn't know valuation? one of the biggest companies on the planet. I'm sure they would know what is valuation, right? When they bid to acquire WhatsApp for $1 billion, they said, "Hey, hello, I'm giving you 100 times your revenue, right? I want to acquire you." WhatsApp said no. Mark Zuckerberg went down to Jancom's place 2 a.m. at night, right? Closed the deal in half an hour, came down, sat in his car, called up his CFO. "We are acquiring WhatsApp for $19 billion. Do the needful." Now the CFO would have called any one of you and said, "Sir, WhatsApp acquisition over $19 billion. I need a valuation certificate under Section 62, right? Or under Income Tax Act." So what do you understand then? So the same company may have different values at the same time, only because different people look at the value of the asset in a different way, right? That's the only reason. So we call it participant specific value. And it's very interesting here to discuss. Let's say tomorrow you become a registered valuer, and there is a company which comes to you and says, "Sir, we want a valuation report from you." You said, "Okay, I will do the valuation." But he says, "Sir, I have an investor who has agreed to put in 1 crore against a 10% stake. I need a valuation report." अभी क्या करेंगे? What will you do?
इन्वेस्टर के हिसाब से वैल्यूएशन पॉइंट ऑफ व्यू से वैल्यूएशन करेंगे.
Okay. This call is getting recorded, so Ani, be very careful what you say.
So we'll have to understand all the, what are the reasons and why they think that that is the value, and then obviously do an independent verification.
First of all, would you take engagement or not?
Such a transaction cannot be supported by valuation report, no? It
No,
is
but
just
again, see, let's understand the query once again. So I'm saying
Pardon,
you are
sir?
a registered valuer.
Yeah.
I'm saying let's understand the question once again. You are a registered valuer. A company comes and tells you that, "Sir, we want a valuation report. We under Section 62 of Companies Act, we have a investor. We have an investor who is willing to put in 1 crore rupees against a 10% stake in the company, right? And here are the projections of the company. I need a valuation report." What do you do? Can you take up the engagement or not? First of all,
Yeah, we'll take up. Why not?
okay. When you take up the engagement, right?
Yeah.
What will be the value of the company? What will be the value of the company?
We have to make the valuation, no? Then only we come to know what can be the valuation of the company.
First,
But
based
the
on
company has given you the valuation, isn't it?
Pardon, sir?
The company has given you the valuation, is it? The company has said that a
Still, we
investor
go by
is
the
putting 1 crore
valuation
against a 10%
methods.
stake. The company's valuation is 10 crores. Simple.
No, if the company is ready to pay a premium besides the valuation, then I think that's their decision, isn't it?
No, sir. Again, you're not getting that. What I'm trying to say.
I think
Correct.
what they are
But my
willing to
point
pay
is,
is completely different from a valuation. They may be willing to pay 1 rupee or 1 billion rupees, but it is completely different from actual valuation. You probably do the actual valuation, and then if it comes as 9 crores, they are willing to pay 10 crores. So the 1 crore difference is probably that individual who is getting some specific synergy extra valuation out of that acquisition. That's why he's willing to pay.
okay. Yeah. So while we are on this discussion, just allow me a second. I'll pull up the Companies Act Section 62. Internet. Yeah. Okay. So Section 62 says that the company must issue the shares at a value which is determined by the registered valuer. Okay. Now see what is happening in this case. I am a promoter, or I am the management, I am the company, and one of you, let's say Rohit, is the investor. and Rohit is willing to put in money in my company as an angel investor. He says, Vikash, I'm going to give you 1 crore, but I need a 10% stake. I agree to it. So the seller and the buyer of the security has agreed to this valuation. Okay. I agree that, okay, he's going to put in 1 crore and I'm willing to give a 10% stake. Now I go to you, Mr. Subramanieswar, right? And you are doing the valuation. Now I have given you the contents already. Now, if you arrive at a valuation of, let's say, 8 crores, is this report useful to me at all? I will not use this report, isn't it? Because if you give me a valuation of 8 crore, I can't use this report because that will require me to change the terms of the investment with my investor. And I will not agree to it in the first place, because that would mean that I have to give him more stake, isn't it? Because he's willing to put in 1 crore at 10%. If the value of the company is 8 crores only, he will get a bigger stake. Correct? Yes or no? So in the first place, you need to ensure that step number 1, I will do the valuation and you will accept the valuation that arrives there. Right? I cannot take a guarantee from you, or I cannot take a mandate from you where I have to arrive at a 10 crore valuation. So before you are discussing with the investor, get the valuation report from us. Okay, it may be within a range, it may be at the negotiation stage, but after you have arrived at a decision with the investor, then my valuation report is purely a compliance-based valuation report. Okay, number 1. Number 2, there is a possibility that the company is telling you that it has an investor who's willing to put in 1 crore at a 10% stake, but actually the investor is not there, because he may not let you talk to the investor. Investor is not your client, correct? So on one hand, he will tell the investor that I have a valuation report which says the valuation is 10 crores, and on the other hand, he will tell you that I have an investor who's ready to put in 1 crore at a valuation of 10 crores, right? And this happens a lot. I have burnt my fingers. What fingers? I have burnt my head into it, right? So the companies cheat you for that, and you can get into a big trouble there. Third, this investor may be willing to put in 1 crore at 10% stake. Is it necessarily the fair value of the company? Right? So you have to be very careful when you take up such engagements, because you have to you have to comply with both the independence requirement or the fair value requirement, as well as your practical requirement. Because if you do a valuation, the company says, no, this is not the report that we want, they may not pay you the fee. And the law does not give you any immunity in terms of collection of the fees. Trust me. Right? So the client doesn't pay you money, the law will not come at your rescue. Law will tell you, aapne advance mein kyun nahi liya? Why didn't you take the fees in advance? Again, you will say, sir, practically nobody gives fees in advance. Right? So this balance has to be maintained. So number 1, do not take a mandate when the company tells you that this is the value that I want. Number 2, in case, now see, when you do the valuation, there are 2 types of valuation that can be done. One is a value discovery valuation, where you are discovering the fair value of the company. The second is a compliance-based valuation, where the report is required only to substantiate as per the law, right? Only when you are very, very convinced, 100% convinced that the investor and the company are willing to put in at 1 crore, right? At a 10 crore valuation, the investor has done his due diligence. Investor himself has another valuation, has another valuer who has arrived at that 10 crore valuation. You have the investor agreement with you, you have the term sheet with you, right? And now all you are required to do is a compliance-based valuation. Then, and only then, take up the engagement and ensure to say that it is a participant-specific value. It is not a fair value. Okay? Please understand this very carefully and write it in your report that this valuation report is for this transaction only. Are we okay? Otherwise, remember, participant specific value is not a fair value. You cannot say it was a fair value of the shares of the company or of the company. And this is happening a lot. Trust me, it is happening a lot. So we have to be very careful when we are talking about what kind of value is being reported. Okay, are we okay with this? Is this absolutely clear to everybody? And trust me, this will have no implication in your examination, but it will have a lot of implication in your practical life when you become a valuer. A lot of implication. So don't forget this part. Okay, chale aage. Can we move on? Next is premise of value. Now there are different premises given: highest and best use, going concern, as is, where is, orderly liquidation, post transaction. So these are the 5 premises. This is only for tangible assets. Okay, and this is only for tangible assets. Otherwise, we typically look at a going concern value or orderly liquidation value or post transaction value. Right? I'm not going into the details of this. Basically, you are assuming that the company is either going to continue or it is not going to continue. Okay. So that is the going concern or liquidation value. Okay, can we move on? Any questions at this point? No questions at this point. Our end time is 2 o'clock, or no, sorry, it is 11:30, right? The session ends at 11:30, right?
Explain point C.
Explain point C, as is, where is basis. Okay, so first of all, as is, where is value is not relevant for securities and financial assets. Number one. Now, thank you, Hermit ji. Number two, when we say as is, where is basis, you see. So what's the difference between highest and best use and as is, where is? Highest and best use says that what is the optimum value that you can derive from this asset. That is highest and best use. As is, where is means I am I'm assuming that it will not be taken away anywhere. It will not have a lot of revamping. It will not have a lot of repairs, and the useful life or the productivity will not be enhanced for this asset. For example, for a tangible asset, let's say you go to value an asset which is slightly depreciated. Now, when you look at the highest and best use, you might want to say that I will put in so much amount of money for the repairs, which is an outflow of cash, and because of this outflow, the company will or the asset will operate at an optimum level, so the cash flows will increase, right? And therefore, this is the highest value of the asset that we can get. But for as is, where is basis, you say, if I just sell this asset today in the market, so if it is in a good condition, somebody will take it in a good condition. If it is in a bad condition, somebody will take it in a bad condition as scrap, let's say. So I am valuing the asset on an as is, where is basis without changing the life or the productivity of the asset. Are we okay? No renovation, no repair, no increasing the life, right? Not decreasing either. As is, where is basis. ठीक है? चलें आगे? All right, I'll take that as a yes. Then some general points. So valuation approaches and methodologies does not apply where valuation bases are prescribed by a statute. We've already discussed this. And this is consistent with in IVS 105. Now going forward, what I'm going to do is I will compare international valuation standard with ICAI valuation standard for respective points. Okay. This is very important. ICAI valuation standard allows multiple approaches to valuation. And what do you mean by multiple approaches to valuation? For the same asset, ICAI valuation standard says, आपको थोड़ा सा भी doubt लगता है, whenever you have a slightest of doubt, you apply 2 approaches to valuation. You apply both market approach and income approach, or market approach and cost approach, or income approach and cost approach, and so on. Okay. It allows multiple approaches to valuation. Now, IVS also allows multiple approaches to valuation, but it is not very encouraging of it. What does that mean? India valuation standard, ICAI valuation standard says, feel free to apply multiple approaches whenever you have slightest of doubt. International valuation standard says, choose a valuation approach appropriately. Come to the deepest level of conclusion. If you are still not satisfied at all, then consider different approaches to valuation. So both are allowing, but IVS will say, why did you apply multiple approaches when you were not sure of one approach? Right? Or when you could have been sure of one approach. ICAI will say, why didn't you apply different approaches? You could have applied different approaches to valuation. So that's the difference. Okay. Second, and I think this is very important. Okay, very, very important. And only because of this point, I prefer to follow ICAI valuation standards rather than international valuation standard. Only because of this point. What does it say? ICAI valuation standard says when using multiple approaches to valuation, consider the reasonableness of a range of values. Right? What does that mean? You are applying the valuation, you are doing the valuation of a company. You apply two methods: market approach, income approach. Under market approach, the value comes at 97 rupees. Under income approach, the value comes at 107 rupees. Okay. Now, if you are doing valuation under international valuation standards, you are not allowed to give a range of value. Okay. You cannot say 97 and 107 के बीच का कोई भी value ले लो. But if you're doing valuation under ICAI valuation standards, then you can. Okay. So that's the only reason why I will go for ICAI valuation standards, because it gives you the flexibility of giving you a range of value, which international valuation standard does not give. Okay. Second, international ICAI, whenever you have to give a single value, ICAI allows you to arrive at a midpoint value or an average value.
Hello.
International valuation standard doesn't even allow that. Yes, Anil.
Hello. Actually, if you are going,
yes, Anil,
so there are different approaches, but you are getting the flexibility that if anybody be asking you report, do my valuation, so then which will be best fit to the client, so you can go give that report to him. If it suit the market approach, you will go both the report of income approach or market value approach, go to the client, and what the best fit for you, please take it. So you are that is not the standard, I think, with them.
No, sir. I think you got a little bit of an error there. So see, first is the choice of valuation standard. Are you going to follow international or you are going to follow Indian? You cannot choose any of the two. For any particular engagement,
I am asking only
select a set
the
of
ICI. I am only talking about the ICI. ICI, there the flexibility. Either you go for two approach, which is best fit. Number one is for market approach, second is income approach. Whether your client come, okay, I want my valuation for 100 rupees. So being a professional and as per the जो ethics and conduct is there, you can go that way. But you have the flexibility in ICI. You do the valuation as per income approach. You do the valuation as per market approach, and go with the client. If that is suitable to you, please consider what best you want from these two reports. But this is my question.
No,
that is my I am.
So I am not.
Okay, please.
So that's why I'm answering that, sir. So it is not about a flexibility. So in the next slides, we will see that the valuation standards are very particular as to when you can apply market or income or cost approach. You cannot just apply any approach that you want for the convenience of the client. Okay. The valuation standards have specified that these are the circumstances in which you can apply market. These are the circumstances in which you can income or cost approach. Number one. Number two, in most regulations, you have to consider all the three approaches and give them an answer as to why you're not using any of the approaches. So it's not that client wants 10 crore, method A, I get 8, method B, I get 10, method C, I get 12. So 10 is what the client wanted, so I give them 10. No, can't do that. Right? We have to justify that. That's why it's a very responsible profession, because there is a lot of answerability for the registered valuers also. Okay. In the next slide, we'll see how you cannot just choose any approach.
But okay. Sir, is it punishable under the law to give a range of valuation? Because so far we have come to know the value should be specific and it should be a single value. But if you give a range of valuation, is it permitted under the law?
Again, which law are you talking about? That depends.
This so company's registered valuation rules under section 247.
No, no.
Fund based value. Is it fund based?
Let me explain. See, you are guided by Companies Act Section 247. The valuation can be for multiple statutes. For example, if you're doing valuation under insolvency, EIRP, IBC code, you can give a range of value. If you are doing valuation under Companies Act Section 62, etc., you can give a range of value. It does not prohibit. Okay. If you're doing valuation under income tax, you cannot give a range of value. There has to be a specific value. Okay. If you're doing valuation under SEBI, some provisions allow you a range of values. Some say it has to be a specific value. So it depends on what statute or what is the purpose of the valuation. Are we okay?
Got it. Oh, thank you.
Yes. Let's take another point. We have to choose a method that maximizes the relevant observable input and minimizes the unobservable inputs. Anil sir, yahin se aapka answer start hoga, and we will continue to answer your question throughout the rest of our today's presentation for the next 1 hour. So let's say you chose a DCF approach to valuation, right? Now under DCF approach, you have to assume, you have to forecast the financial statements. That forecast is subjective, yes or no? And it is subject to a lot of assumptions. So if you are valuing any company or any asset and you choose the DCF approach straight away, you will have to answer this point. Why did you not take the market approach? So in the hierarchy of the preferred approaches to valuation, market approach comes first. Then comes income approach. Then comes cost approach. Are we okay? So whenever you are applying DCF approach, you have to justify why did you not apply market approach. This is the simplest, easy first point answer. Okay, we'll now go into individual approaches. So this point is mentioned in all the valuation standard. It is mentioned under International Valuation Standard. It is mentioned under ICI Valuation Standard. It is mentioned under Ind AS. That we have to maximize the relevant observable inputs. What does maximize the relevant observable inputs mean? Whatever inputs are going into the valuation, whatever parameters that you are taking under valuation, are these parameters objective or subjective? Observable or unobservable? Market driven or not market driven? Facts or assumptions? So choose the ones which are non-questionable. So for example, what is the value of Reliance Industries today? Right? Reliance Industries share price is, let's say, 2,100 rupees or whatever it is. So it is a relevant observable input. No assumption required. It is given by the market. You take that, no more question. Now you apply DCF approach. That means you will take all the businesses of Reliance Industries, try to calculate the DCF approach and say, hey, see, I have done the discounted cash flow valuation, which is better. No, sir, it is not better. The market sees it differently. It is not, DCF method is not observable inputs to valuation. Are we okay? Make sense?
Can
I go ahead?
when you are going for, yeah, one question, one question. When
Yes,
you
sir.
going
Yes,
for
yes.
valuation and can you supplementary do you can simultaneously do the income approach, or you are just understanding, yeah, only give the valuation code based on the market approach?
No, sir. You can apply multiple approaches together. We'll discuss it right now. Okay? We will discuss the scenarios. Let us go to the market approach, and I will answer your point exactly in the next slide. Market approach is when that uses prices and other relevant information generated by the market transactions involving identical or comparable assets, liabilities, or group of assets and liabilities. Basically, whenever you are using the market prices, that is when we talk about market approach. Market prices can be over the counter, which is individual transactions, or stock exchange driven. Okay. See here, where to apply market approach. Where the asset to be valued or a comparable or identical asset is traded in the active market. Whenever there is an active market of the asset that you are valuing or of a very comparable asset. Second, when there is a recent orderly transaction in the asset to be valued, orderly transaction. Okay. There is a comparable company. Third, there are recent comparable orderly transaction in identical or comparable assets, and information for the same is available and reliable. Okay. Now, again, let me give you examples of one of all these three. When the company or a comparable company is traded in the stock exchange or in an active market. So you are valuing Flipkart. Flipkart is not a listed company, but Flipkart has a comparable company, Amazon, which is listed in the stock exchange. So you are valuing Amazon, you can take Amazon's price. You are valuing Flipkart, you can take Amazon's price. Traded in the active market. Okay. Second, there is recent orderly transaction in the asset to be valued. You are valuing Flipkart. Flipkart recently had a previous transaction by some other investor. You take that transaction as the base to do the valuation of Flipkart now. Okay. Orderly transaction of the same asset to be valued. Third, there are recent comparable orderly transactions in identical or comparable assets. Not in the stock exchange, but there is some other transaction that happened of an identical company. And I will take examples of explaining this in the next slides. ठीक है सर? मैं एक are we okay, sir? Can we go ahead? B point. There is recent orderly transaction. So again, let's okay. Byju's is an unlisted company, correct? Byju's is an unlisted company, and Byju's has had series of transactions. Slide only, right? Yes. Huh. You want this point, isn't it, Harmeet sir?
Yes.
Huh. So Byju's is an unlisted company, and we cannot think of any listed comparable company of Byju's. It is into edtech, and there is no edtech listed company that we can think of. So Byju's had a recent transaction. So let's say we are sitting in September 2020. In July, Byju's had raised a round of funding. You are doing the funding, you are doing the valuation in September for the next round of funding. So can you take July's transaction as a base? Yes, you can. Got it? ठीक है सर?
Yes.
चले आगे?
Yes.
Does orderly transaction mean price set at arm's length? Yes, orderly transaction means arm's length price, fair value. Orderly transaction word is coming from fair value, which is arm's length transaction. Okay? चलते हैं. Market approach method. Now, market approach method के अंदर में we were just discussing कि what if you are valuing one company which has got multiple investments, let's say Reliance Industries, Infosys, TCS, Wipro, and so on. And I got a unanimous answer that for Reliance Industries, TCS, Wipro, we should take the stock exchange price, correct? Yes. Let's say you are doing the valuation as on 31st March 2020. You are doing it for financial reporting purposes as on 31st March 2020. Which price will you take for Reliance Industries, Infosys, TCS? कौन सा प्राइस लेंगे? 31st March 2020 का लेंगे, कुछ और लेंगे? No. 31st March. Current price, 1st March price, 31st March. Okay, right? So here, this is one point which most people, and I say most people, including listed companies, have been doing incorrectly. Large listed companies are also doing it incorrectly. Let's see why. When you use the market price method, then you have to take the traded price over a reasonable period. Not 31st March, but you need to take the traded price over a period. So let's say you will take between 1st March and 31st March, take the average price of this. Or between January and March, average price. Or even between March and April, let's say, but average price. Do not take the same date price. Okay, very important. Second, consider the market where the trading volume is the highest. What does this mean? The stock is listed on Calcutta Stock Exchange and Bombay Stock Exchange. Calcutta Stock Exchange does not have trading. Okay, Calcutta Stock Exchange में trading नहीं होती है. Bombay Stock Exchange में trading volume is higher. Okay, the company wanted a higher value of the investment. As on 31st March, they entered into a trade at Calcutta Stock Exchange for rupees 200, whereas the average price is around 100. You take 200 as the market price, the value becomes higher. Yes or no? Are you getting my point? So again, it should be market driven. So if there are more players in the market, then the price manipulation scope reduces. Correct? So therefore, you take the market where the trading volume is the highest. Third, you take the average price, preferably volume weighted price. What does this mean again? The market closes at, let's say, 3:15 or 3:30. I don't know what time it closes exactly. 3:15, I guess, right? So at 3:13, 3:30, okay. So at 3:25, you ask 10 of your employees, ki chalo bhai, sit on the terminal and enter trades. Okay, jack up the price as on 31st March or reduce the price as on 31st March. Okay, so therefore the market price approach says that you need to take all of these three into account. A reasonable period, not reasonable price. So reasonable period is not defined in the valuation standard, but look at this example. The same point is confirmed under SEBI. Okay, SEBI, issue of capital and disclosure requirements. I'm just giving you this as an example. Okay, this is only an example. It prescribes that for frequently traded shares, the volume weighted average price of 26 weeks or 2 weeks preceding the relevant date, whichever is higher, should be considered. So here the reasonable period that SEBI says is 26 weeks, which is 6 months, or 2 weeks, whichever is higher. Think about it, and it is very intuitive. If you had to do the valuation as on 31st March 2020, the share prices of all the stocks as on 31st March 2020 were very, very low this year, isn't it? Because in the third week of March, the news for COVID came in. And as on 31st March, the Sensex had gone down to around 28, 29,000. Whereas earlier it was around 34, 35,000. So there was a significant decline in the value of all the shares as on 31st March. Okay. So you take the volume weighted average price. You can take it for the last 2 months or 3 months. That's up to you, right?
So this
But take a volume weighted average price.
This 26 weeks
Yeah.
or 2 weeks can be like before 31st March also and after 31st March also. Is it possible? Like we can compare any of them?
No. Again, SEBI says preceding.
Preceding.
Okay? SEBI says preceding. So you cannot take after that. But see, this is one example. I'm saying for Ind AS purposes, let's say, right? Again, we usually never go before the valuation date, but technically speaking, maybe you can. But yeah, I would not advise that. So we usually take the preceding, the last 12 months or last 6 months average price. We take that. Okay. And how would you get this? How would you calculate this? So you get traded turnover and you get the number of shares. Okay, you get it for all the days. You get it for all the days. You take the sum of this and you take the sum of this. Okay. So A divided by B will give you the volume weighted average price. Okay, sum of A divided by sum of B will give you the volume weighted average price. Are we okay on this?
We have to choose the high and low prices of the week, no?
Closing price, closing. Sorry, yeah, you can just take the closing price.
Closing price.
Because see, you don't need this, because when you're taking the traded turnover and number of shares, right? This considers all the trades on each of those dates, and this considers all the shares of on each of those dates. So closing turnover does not matter. The closing price does not matter. Okay. Can we go on? Chale aage? So this is one very important thing which people miss out, and you should be very, very careful in doing this.
My
So what
question.
happens these days?
Hello.
Haji Anil ji.
My question is that
Yes, sir.
कि सपोज करो कि मैं टुडे आई एम वैल्यू टुडे इज 99, तो आई एम गोइंग टू वैल्यूएशन टुडे, तो व्हाट विल बी माय दिस 2 weeks and 26 weeks from after proceeding from today, or what it is date on 31st March, like that evaluation from 31st March?
No.
Hello.
See, the valuation date will be 31st March for Ind AS purposes, right? So you will take 2 weeks or 26 weeks before 31st March. Today is your report date. Valuation date is the cutoff date on which you are doing the valuation, on which you get all the information. So typically it will be 31st March is the valuation date. 26 weeks before 31st March. Today will be the signing date, report date.
Okay, so if I am going to valuation today, so I have to be considered on 31st March for my calculation purpose, valuation purpose.
No, that's sorry. So you have to decide what is the valuation date. If the valuation date is today, then you take 26 weeks before today, no problem.
Okay.
So the date of valuation is the relevant date, is it? Or is it the date?
26 weeks preceding the relevant date. The relevant date is the valuation date. Is date की valuation करता है.
Okay.
Sometimes if you will go for the income approach, so then income approach, then we financially is not ready for last 6 months, then you have to be go for 31st March based on 5 years or 5 years estimation.
नहीं sir, income approach is not applicable here. No? We are looking at market approach right now.
Okay.
Next approach is comparable companies multiple method. Let me take you straight to the example, right? So let's say, how would you value a company like Flipkart if you are asked to value Flipkart today? Okay. Simply speaking, how would you, let's say you are a venture capitalist. You are a venture capitalist and you are valuing, you are going to value Flipkart for the next round of funding, right? How would you approach the valuation? How would you calculate Flipkart's value? First time valuation हो रहा है मान लीजिए Flipkart का, and you are a venture capitalist.
So take the valuation of any same line company like Amazon.
Okay, and then what will you do with that?
And
Great.
considering the
We are on the
valuation
right
report, considering the valuation report of the Amazon or some other companies in the same line of business, we have to get a figure. Okay, what can be the approach for this kind of company, and then we have to do the following approach. Okay, in respect of this company.
Okay, yeah. So that is very brief and precise. So let's say if you have to value Flipkart, what you could do is we can do based on the basis of listed comparable companies, right? Which is Amazon, absolutely right. Now inputs could be Amazon's market capitalization, number of users on Amazon, number of users on Flipkart. Okay. Now see, I want to bring in a very important point that for most companies, there is a value driver. What is it that drives the value of that company? For example, yesterday when we saw Jubilant Foodworks, we knew that the value driver was average revenue per store, isn't it? Yes or no? Higher average revenue per store means higher value for the company, right? That is one key value driver. Similarly, for an e-commerce company, the value driver is number of active users, okay? Or it could be order size. So let's say we look at Amazon's value per user. So we get Amazon's market capitalization. What is Amazon's market capitalization? You look at the market cap of Amazon, it is listed in the US, correct? And you divide by the number of users on Amazon. This you can get from the annual report of Amazon, correct? Yes or no? Right? Are we all together, sir?
Yes.
Yeah. So now you get Amazon's value per user. This value per user can help you get the base value of Flipkart. So number of users on Flipkart multiplied by this value, correct? Ballpark value आ जाएगा. right? But now you cannot report this value. Reason being that this value requires a lot of adjustments. Now, the moment you get this, you will say, Vikash, itna easy hota hai kya valuation? Valuation is not that easy, right? Now you start thinking differences between Amazon and Flipkart. What are the differences between Amazon and Flipkart? Amazon is a bigger company than Flipkart. Amazon is listed, Flipkart is unlisted. So Amazon shares can be easily traded, Flipkart shares cannot be easily traded. So there should be one higher value for Amazon, lower value for Flipkart. Correct? Correct. Second, you would say, because Amazon has a lot of businesses which Flipkart does not have. For example, Amazon has Amazon Prime. We don't have a Flipkart Prime. Amazon has AWS services or cloud computing services or developer services, which again Flipkart doesn't have. So Amazon's value includes value for e-commerce also, for cloud services also, for Prime also, and other services also. Flipkart is only e-commerce. So I have to do the adjustment for the other two businesses. Okay, number second point. Third, Amazon is available in multiple countries. Flipkart is available only in one country. Right? Difference. Fourth, Amazon has, so again, we've talked about product diversity. Amazon's valuation is in US dollars, and Flipkart's valuation will be in Indian rupees. So at least these adjustments are there. So discount for lack of marketability, listed versus unlisted. Global diversity, multiple countries versus same country. Product diversification, meaning different products, Amazon Prime, cloud, retail, e-commerce, etc. versus only e-commerce. Adjustment for currency differences and country-specific factors, US growth versus India growth. You make these adjustments and then you say, okay, this is a ballpark value of Flipkart. Can we do that? And trust me, if you think that because these are still subjective, yes, but these are not even close when we talk about subjectivity involved in valuation of Flipkart using DCF method. You can never value a company precisely using DCF method like that. Okay? Are we okay with this? Yeah, no. So we're talking, correct. So we are doing that adjustment, right? When we are doing the value per user, we are making country-specific factors and currency factors. Again, see, okay, I am only trying to give you an indication of how valuation can be done, which is not conventional. How this is exactly how a venture capitalist would look at the value. People who invest in the shares of companies, right, do not carry out a DCF analysis. Trust me, friends. They look at these methods only. They look at a ballpark figure. Then they do a DCF valuation to see, okay, kya valuation aata hai? What is the exact value that I might be looking at?
If there is no, if there is no comparable and they have the monopoly, only one company which are doing this.
We'll see that again, sir. We'll see that. So again, remember when we are talking about market approach, first let us finish market approach. Market approach always says there is some comparable. Close or distant, but there is a comparable. So let us finish that. Then we'll go into a situation where there is no comparable. If there is no comparable, you have to go into an income approach. No problem. You have to go into DCF approach then. Okay. So this is one example. Let us take another example. This example. Now you are valuing a steel company. Let's say a well-established steel company, not a contemporary, fast-growing company like that. But you're talking about a simple, plain vanilla steel company. Okay. What do? It's a large company, but it's an unlisted company. How can you value that company? You look at 5 listed comparables again. Usha Martin, Sunflag Iron, Adhunik Industries, Kalyani Steel, GSW Steel. Okay. You take their revenues. These are all listed companies. But you're valuing this is unlisted. Okay. And these are all listed companies. So you get the revenue, you get earnings per share, you get number of shares, you get their average price. This is all available in the market, yes or no? Right? You take that. With this, let's say you can calculate the price to earnings ratio and price to sales ratio of each of these companies. Are we okay with this? This is fairly simple. So revenue is so much, number of shares is this much. So revenue divided by number of shares will give you revenue per share. Price divided by revenue per share will give you price to sales ratio, correct? And you have average price and EPS, you get 2.34. Can one person just confirm how to get 0.66? As an example, can you show it in the chat window? How did we get 0.66? Right. So you get price into number of shares divided by revenue. Perfect. Okay. So either you take revenue per share and then divide it by the price, or you take price into number of shares and divide revenue. Correct. Okay. Now see, we can get the average of all of these, and we can say, okay, the average price to earnings multiple multiplied by the earnings of this company should give you the value of the company. Yes or no? This is how revenue multiples work, right? What happened? So you take the average of these. So this is average PE, right? So what is the value? Value will be given by earnings into P multiple, or it will be given by sales into price to sales multiple. Yes or no? Correct. So I could take 28.01, multiply this by the PAT of the company. Okay, reported values of A Limited, PAT. This would give you this value, correct? 28.01 into 13.02 is equal to this, but this will not be the value because we have not taken 28.01. Why should we not take 28.01 here? Can someone tell me? There is an outlier, right? If you see, I have taken 5 companies, but out of these 5 companies, there is one company which is an outlier. The average is 28.01 only because there is this big PE ratio multiple company which is sitting out here. Okay. And because of this company, the average has gone up very high. Otherwise, the average would have been somewhere around 5, isn't it? 2.34, 4.83, 7.07, 7.2. Somewhere around 5 kuch aata. Correct? So therefore, instead of taking average, I can take the median value. The median value, it is a midpoint value. So you arrange all these numbers in sequential order. So there are 5 companies, right? Sequential order would be 2.34, 4.83, 7.07, 7.20, 118.63. Mid value is 7.07, which is this value. Okay. So you take the median value and now multiply this with this, and what you get is 92036.79. Are we okay? Right? So we can use the price to earnings multiple. You divide it by the number of shares. This is the price per share that you get. And using the price to sales ratio also, we have taken median only. And therefore you get 28.73. So this is your range of value. See. Are we okay? Can we move on?
Is it possible that the transaction can happen even beyond this range given in the valuation report? Can be higher than what has been quoted, or it can be lower than the valuation we have read it?
Sorry, say that again, sir.
Now, in this case, we are given a range from 28 rupees to 32 rupees. Is it possible in real scenario whether this transaction can happen even at 35 rupees or even at 25 rupees? It's not necessary that the transaction should get consumed within this.
See, that is not for us to decide. That is for the company to decide.
Yeah, understood. But
ideally, the transaction must happen within this range.
Okay.
See, we are not doing valuation for market purposes, sir. our valuation will always be a valuation which is on the table,
Yeah.
right? So whoever has assigned us to do the valuation, we have given them the range. So as per law, they should do the transaction between this range only. If they are doing a transaction outside of this range.
Yeah, I understood. So we are giving a base range of valuation. So I'm just asking whether in the market when these things happen, it could have it is a possibility that it could have happened even beyond this range. That's what I'm trying to understand.
Yeah, that can happen. Yes. Okay. Let us take one more example. So this was an example of comparable companies multiple method. Okay, you are valuing one unlisted company against multiple listed companies which are traded. So you are taking the stock exchange driven ratios, right, or market prices. Okay. Let us take another example where you are valuing a company which is not traded and which does not have a traded comparable company. Let's take this example. You are valuing a messaging company, a text messaging company called Chat App, which has 1.6 million users, and the company does not generate any revenue. If you have to value the company, how would you value this company?
So we look for valuation of companies of similar chat companies that are there in the public domain, if we can get any information on that, and try to look at some of those key parameters that we discussed, whether it is the number of users, etc., as a starting point.
Okay. I could say I would simply look at the balance sheet of the company and report the values as based on NAV. The company does not generate any revenues, right?
We can check
Yes or no?
all the transactions which happened in the company.
Okay, no, but my question is why not NAV? Why shouldn't we take the balance sheet value just?
Because it is not showing any revenue. So it will only be the cost.
It will have a balance sheet, right?
Yeah.
No, but it will have a balance sheet. So
it will have a balance sheet, but that will be historic
one side, capital on the other side.
It won't reflect the true future potential.
True value. Yeah.
Okay. Now, what if I said that it has 1600 users? Now, would your answer change? No. Would your answer change then? Yes, Shashanto sir.
So it also depends on what is the equity amount invested and how old or young is the company. Because if it is, let's say, 1.6 million users with very almost negligible revenues, then you're obviously reporting a loss, which means that the equity would be technically negative. So you would want to value it based on future potential. And yeah, so if it's a 2-year-old company with 1600 users, again, I think you would still have to factor in, what is the future potential at that point in time.
Okay. If this company has already invested,
so let's see again. Yes, sir. Go on.
If there is an earlier investment in this company, a first round investment, maybe we can use that as a benchmark and then arrive at the valuation.
Let's say this is the first valuation. I see. These are so all the examples that I'm taking from Flipkart to the A Steel Limited to these companies. These are all similar transactions that I have encountered as valuer. These are not just hypothetical examples, and neither have they been picked up from any book. Okay, so you have to understand that in real life this is what happens. I am sitting in Bangalore right now, okay, and most of these startup companies, and it's become fancy right now. I get companies who say, Vikash, we were formed in August 2020. 20th August 2020 was our incorporation date. We have a great idea. I have 4 investors lying up with me, right? Because earlier we were doing some pilot in some business or whatever. We are 4 promoters who are big shots in their own respective domains, right? And we are looking at a valuation of 125 crores based on PPT, one PowerPoint presentation, right? So, and we've seen valuations happening like that. We have seen valuations happening like that. Just that now I am not taking up such engagements because most of these engagements ultimately get blown off later, right? So you really have to understand what is happening here. First of all, just because an investor is lining up outside does not qualify for a reason to give a higher value to this company. Okay, the presence of an investor does not matter because you will not be able to find out whether that investor is his childhood friend or not. Okay, so, and second, there has to be a huge judgment call between 1600 users and 160 users. I can create an app for 20,000 rupees today. Clear? Everyone is agrees to that. I can create an app for 20,000 rupees.
Yes.
With this app, I go to a college. And I say, I am offering internships to all of you. There's a marketing internship, right? There's a 3,000 rupees stipend that I will give you. But all of you have to register on my portal and fill up the form. I get 1600 users at the blink of an eye. Yes or no?
Yeah.
And are these users valuable to me? The answer is no, irrespective of whatever is there in my balance sheet, right? Irrespective of whatever is there in my balance sheet. So 1600 users is no value at all. I will have to look at the NAV. And if I see that the NAV is negative, like Rohit was saying, that in some cases the NAV, the shareholders' wealth can be negative. Fine. What is the purpose of my valuation? Issue of shares. Issue of shares cannot happen below the par value, which is 10 rupees, usually the face value. So your valuation is face value, plain and simple. You don't have to do the valuation at all. You can look at the balance sheet without doing any calculation. You see it is negative. The business does not have any worth. Issue at par value. Kaam khatam. Done. Are we okay with this? Yeah. On the other hand, 1.6 million users is not nothing. The company has done something to get 16 lakh users. 16 lakh users we cannot get overnight. Okay. So now in this case, I have to find a comparable company. It is not fair to value a company which has 1.6 million users based on their NAV only. I should consider the NAV, by the way. But let us see if there can be anything else. So what is it? This is a chat messaging company. This is a text messaging app, right? I can think of a real life example, Hike. Have you heard of Hike? Yeah. Do you know who owns Hike? Who's the developer of Hike? Who's created Hike? It's an India-based app, by the way, right? And it has been created by Kevin Mittal, who's the son of Sunil Bharti Mittal, who's the chairman of Airtel. It has not been created by Airtel. And it has been around for almost a decade now. And it does not charge any money as far as I know. But it had a valuation of, I think, $1 billion about 5 years ago. That's what I saw in Forbes. Yeah. So BlackBerry Messenger could be BlackBerry Messenger. No one's using it anymore today, right? But we can talk about, let's say, Telegram, if for that matter, right? So how do you value companies like that? Let's see. Comparable transaction multiple method. So we know that enterprise value of WhatsApp was $19 billion, right? Let's start from there. $19 billion. At the time of acquisition, what was the daily active users of WhatsApp? 450 million users at the time of acquisition. Okay. So what is the value per user? $42. Correct? Are we all okay? So we never paid a single rupee to use WhatsApp, but WhatsApp sold each one of us $42 each. Correct? Facebook acquired us for $42 each at that time. 2013, I think that acquisition happened. So this is the value per daily active users, just the way we did it for Amazon. Multiplied with the exchange rate, you get the value per daily active user in rupees, whatever exchange rate you will apply, 70, 60, 72, 75, whatever it is. Okay. Now, can you value the company based on this? Can you simply multiply this with 1.6 million users to get the value? No, that will be unfair. Why? Because if there is a difference between 1600 and 1.6 million, there is a huge difference between 1.6 million and 450 million users as well. Yes or no? Yeah. So for this company, for anyone who has just started, to reach 1.6 million users takes a hell lot of time. But from 1.6 million users to 450 million users, and today WhatsApp is 1.3 billion users. 1.3 billion users is the usage of what is the number of users on WhatsApp. I think it should be more than that, right? So we take a size adjustment. Let's say we take a 80% haircut, the only subjectivity in this entire valuation. You say, let's take a 80% haircut. And if you take a 80% haircut, that is subtraction, you get value per user 591.11. Value per user. 591.11 multiplied by 1.6 million gives you 945. That is 94.58 crores. Are you okay on this? Yes? Makes sense? Now, I am up for argument on 80% adjustment.
My question is one thing coming in my mind, but this type of company is coming in market and rapidly they are wiping off, they are not performing well because some competition is coming, some new app is coming.
Yeah.
Hello?
Yes, sir. I agree. Yes.
When
I heard you,
we
sir.
are
Sir, I have a doubt. Simply just prorating the.
Yes, sir. Let me address Anilji's question first.
Okay.
Sir, Sushant, sir, let me address Anilji's question first. So, sir, I totally understand and agree, and that is why I said that in real life, if I was given exactly the same thing, that's why I've already mentioned this requires discussion, right? I can take a 99% haircut also. See, what is 1.6 million divided by 450 million?
Correct.
1.6 million divided by 450 million is, I think, 99.4% or something like that, right? So this 59, I can say, sir, not 59. I will take 50, not 591. I will take only 59. The value would be somewhere around 1 crore. Yes or no? Now, this 80% adjustment that you will do will be based on your subjective assessment of the company. You will see how credible is the company, how high is the user engagement rate. 1.6 million will not come overnight. So is there a steady increase in the user engagement? What are the plans of the company? What is the competitive advantage? What are the other? Have we seen a shift from other apps to your app? Right? Based on these factors, you will apply this adjustment factor. Correct?
Yeah.
Still, the value of such companies can be anywhere between 100 rupees to 100 crore rupees. Yes or no? Did you hear a recent acquisition of White Hat Junior?
Yes, 300 million by Byju's. $300 million.
$350 million acquisition by Byju's, right? Now, my daughter is a White Hat Junior student. She's 8 years old. We paid 28,000 rupees for that one course. And it's a damn good course, I must tell you that. But I was never aware of the number of students that it has. So when the acquisition happened for 350 million users, I felt, what is wrong with them? Why have they sold so cheap? Why? Because think about it. If the acquisition is $350 million, and the per student fees is 28,000 rupees. That means if you divide it, you are saying for 8 lakh students, you get this entire value, isn't it? And Whitehead Junior has got Madhuri Dixit, Virendra Sehwag, and who not advertising for them. And it's a good course, right? And it's about coding. And it is the future of education for today's children. And I felt that this acquisition was really, really cheap. Because 8 lakh students to aise hi aa jayenge. But then I realized the number of students that it has is only 12,000. Only 12,000 students. So all of a sudden, the expectation dropped like a bomb, isn't it? I thought that 8 lakh students to bahut aaram se honge unke. But then I realized they have only 12,000 students. So that means all of a sudden the company has become very expensive, isn't it? But maybe Byju's felt that yes, 8 lakh students, it can easily integrate between them. Correct? So you really have to see the quality of the company. All these numbers that we are doing is only quantitative. The qualitative thing we are not discussing as of now. Right? Yes, Sushanta sir, you had a question?
My
Sushanta sir,
contention
you had a
was,
question?
yeah, my contention was that simply by prorating the factor, there are so many other factors which has to be considered to arrive at the value of this type of company.
Correct. And I just discussed those factors, right?
Yeah, you have explained it. Correct.
Thank you, sir. So again, I just another slide, right? It is 99.64% adjustment size, and the value becomes 1.68 crore. So only because the size adjustment could be so high. So here we took 80%, which was a thumb rule, and here we said 99.64%. How did we get it? So 1.6 million divided by 450 million is how much? This would be around 0.56% or 0.46%. So I take 0.46% of this value and I get 10 rupees per user as the value, right? And the value drops from 94 crores to 1 crore. And that's how funny valuation can be. Okay.
But from a different perspective, from a lower base, the growth rate can be phenomenal and geometric. So should the valuation be not higher from a lower base rather than giving such a size adjustment?
Correct, absolutely. See, that's why I've given you two very broad ranges, right? See, this 80% was subjective. This 99.64% can be calculated objectively. Now, if you were the promoter of the company, you would say, Vikash, come on, are you kidding me? I'm not going to sell my company at 1 crore valuation, right? And then you would give the example or the argument that you just gave, and we'll say, okay, no, we'll take it at 95% discount and not a 99% discount. But as a valuer, you will have to be convinced about it based on the factors that we just discussed. I'm just giving you an example that only by changing this one small parameter, the value of the company can change significantly. And in both the examples, 80% or 99.64, there is an element of substance. I mean, there is an element of justification. We are justifying both the numbers. Yeah. It's just about where do we close it, right? And therefore, there is no software for valuation because it requires subjective assessment.
Yes, luckily robotics cannot come here.
Chali, sir. We'll move into... yeah, no. So robotics can talk about market approach, but not these, right? Anyway, sir, I'm doing some more research on valuation of private companies. Let's see if we can get to something, right? But anyways, coming to the income approach, let's talk about when do we apply income approach. So see, where the asset does not have any market comparable or comparable transaction. So that is when you apply income approach. Anil sir, I hope you're listening, right? So only when the asset does not have any market comparable or comparable transaction, or where the asset has fewer relevant market comparables, they don't have it or very few market comparables, or where the asset is an income producing asset for which the future cash flows are available and can reasonably be projected. If it's an income producing asset. So in our example, just the previous example that we took, Hike, right? It was not an income producing asset or chat messaging app. It is not generating any income. So how do we value it, right? Next, now this is mentioned by Indian Valuation Standard. International additionally mentions that the income producing ability of the asset is the critical element affecting the value from participant perspective. What does this mean? Let's say we are not doing land and building valuation, but let's say you are hired to value a building, an office property. Let's say there is a big office that is there, and you have to value that office, and that office is currently given on rent. It is my property and it is given on rent, and I derive 2 lakh rupees as monthly rent from that office. How would you value that office or that flat, whatever it is, office building or flat, irrespective? How would I value that flat or that office?
Rental cap multiplier.
Sorry, rental cap multiplier. Okay, yeah. Anybody else? Discount the projected rental inflows. Kya baat hai, sir? Right now, see, there is a reason why international valuation standards have put this clause here. Whichever part of the country you are in, what is the rental yield on your property? 2%, 3%. That's it, right? Yes or no? If you are using income approach to value a residential property, can you imagine what is the level of subjectivity that you are putting it to? When even if you're thinking 2 lakh rupees as your current rental income, you are assuming that your house will forever be occupied, and you will get a steady flow of 2 lakh rupees rental income, either fixed or growing at a steady rate, right? And still, you don't know what is the life of that house, 50 years, 60 years, 10 years. So why go into such subjectivity? Look at the property next door. Simple. Use the market approach. Take quotations from 10 brokers and they will tell you kya value hona chahiye is house ka. Take that value, right? You don't need to put income approach there, even if you're deriving rental income. Okay? Because the income producing ability of a real estate property is not the critical element in the valuation of that property. Okay?
You're from Bangalore, right? I want to give a funny example in Bangalore.
I'm not from Bangalore, sir.
I mean,
from
sorry,
Kolkata. I am in Bangalore, right?
You're in Bangalore. Sorry. Most of the buildings in Bangalore, they sell that this building gives you a rent of 45 lakhs per annum. So multiply by 8 or multiply by 10. That is what the price the owner is quoting. This is the most common thing, especially on the Marthahalli and the IT segment side. That's how they quote.
No, agree. So at the end of the day, what comes first, egg or the chicken? Got it. But then I'm saying from a valuer, from a valuation report perspective, if you look at the discounted cash flow, you are putting it to subjectivity. The assumption is what is the rent, what will be the rent, the occupancy rate, the increase in rental income, the discount rate. So all of those are subjective. Instead, take the relevant observable input, take quotation from 10 brokers. What should be the value of this property? They will give you that property. Take the quotation, take the stamp duty valuation from the government website, right? Compare all of them, put them together, come up with a value, right? Easier. Finally, remember also that also consider when along with other approaches. So if the timing is uncertain, the amount of future income is uncertain, there is lack of access to information, or if the asset is not generating income but is projected to do so, then you use income approach along with other approaches. Okay, so then you can use income and market or income and cost approach if these three conditions are there. So if there is subjectivity in the cash flows, then you do not apply only income approach, you apply income and market or income and cost or all three. Okay, for example, if you would be doing valuation for listed companies which are reportable under SEBI, let's say you are doing valuation for mergers and acquisitions for listed companies, SEBI requires you to report valuation under all the three approaches: market, income and cost. Okay, so we have to take that into account. Can we move on? I don't have time today, right? It's already 11:27. So what I'll do is, since you are already familiar with this, with free cash flow and free cash flow for firm and equity, let me just quickly jump to the the cost approach, right? And when do you apply cost approach? So you apply cost approach where income or market approach cannot be used. Number one, when an asset can be quickly recreated with substantially the same utility as the asset to be valued, that is reproduction cost, or when the liquidation value is to be determined. So this is important. Remember, whenever you are calculating liquidation value, then you have to use the cost approach or the NAV approach. Okay. Next, also use cost approach along with other approaches when the asset has not started generating income. So what would you do? Cost approach and income approach or market approach. Okay. When an asset has substantially same utility can be recreated, but there are regulatory or legal hurdles. So you can recreate it, but there are regulatory hurdles, right? For example, telecom companies, telecom licenses. A new company can come in today and start selling telecom services, but there would be legal hurdles. So you cannot just take Airtel as a comparable company. And if the asset was recently created, so new assets once again, right, these two are almost similar. So you use cost approach along with other approaches. Are we okay? Okay. I'm going to share the presentation with you. Do you have any questions? Do you have any questions?
My question is that there are so many companies, they are doing, hello?
Yes,
They
sir.
are working as working as a vendor to the like Maruti, like pharma company. So their valuation should be based on the cost approach or what? Because they are only dependent on this the company who are giving their business as a job worker vendor.
Not necessarily, sir. So it depends on which company you are valuing. So let's say you are valuing one company. Let's say you are valuing Amara Raja Batteries, okay, which creates
My question
batteries
is
for all the cars.
different. My question is different. Suppose I am making the steering for the Maruti Suzuki, and
Mhm.
based on they are saying that you have to be develop the steering for the Maruti Swift, and we
Uh-huh.
have the plant and we have the capacity like that. If we are making only the 1 lakh steering per month, and we are dependent on the
Correct.
Maruti, they will give me business. So what will be the approach will be better for valuation this type of company?
Sir, I would go if based on the example that you're sharing, I will go with income approach, right? Because if I'm even if I'm selling it to Maruti only, uh, sir has left the meeting. Okay, okay. I'll wait for him to join back again. Yes, Anilji, you are back.
Oh, it was disconnected.
You're back, right? So I was waiting for you
Yes,
to join back, right?
yes,
So
yes.
even
Yes.
if I'm selling my steering only to Maruti, right? Maruti is my customer, so I
Yeah.
will still project the future cash flows and value the company using the income approach or DCF approach. However, I will have to factor in two, three things here. One, I will have to see, is there an exclusivity arrangement? Does the agreement say that I cannot sell to any other company at all? If that is the case, then my value would come at a discount because then my risk goes high that tomorrow if Maruti cancels my license, I have nowhere to go. But if you're asking about the approach, I can simply apply the income approach in that case.
Okay, thanks.
Okay. Yeah. All right, sir. Thank you very much. I will share this presentation with you. If you have any questions around today's session also, we can discuss it tomorrow. Tomorrow we will take up Ind AS. So we will discuss three Ind AS standards. One of them is very similar to what we discussed today. While I'm sending this presentation, I also want you to look at this slide, which talks about free cash flow to the equity and free cash flow to the firm. Okay. So it will be a good reference point for you. And if you want, we will be able to explain it tomorrow to you. Are we okay? Yeah. Okay. Great. Thank you.